Now on Sky News Business, this is Trading Day, live.
Well, let's speak with Andrew Macken, Portfolio Manager at Sydney-based Montgomery Global Investment Management. He is live with me in studio. Warm welcome to you and into the new year.
Happy New Year.
The metrics that kind of govern your thinking are basically in what order? What's the kind of rule book that you're working to when it comes to an asset allocation proposition?
Well, the rule book for us, when you're buying any asset, is simply to buy it when it's only undervalued.
Right.
And that sounds obvious. And the interesting thing is it's not very easy to do, and very few people do it. To do that, we basically say, let's take a business, let's say what are the key value drivers of that business, and we spend a lot of time reverse engineering what is built into the current stock price with respect to those key value drivers and what the market is expecting. And then we will only buy a business if the market implied expectations are too conservative, which is a very long-winded way of saying the business is undervalued.
Right.
So that's what we do for every single business that we own. Now, of course, we only invest in global equities, and typically the only businesses we will buy are high quality in nature, meaning they can earn high returns on invested capital for a sustained period of time.
What about when the holdings in those same said businesses have an overweight family ownership component to them, so that you know at the end of the day there's a certain direction that will be exercised, and you're kind of hamstrung, whether you wanted to or not, to influence that? You're going to be very much in the back seat, to coin the phrase. How much of a swerve factor? No pun intended.
Yeah, look, that's an interesting question. It's not one that I've been asked too frequently. It's definitely a consideration. It could work against you. It could actually work for you. I mean, if there's a family that's invested heavily in the business, they obviously take a very, very long-term view. They're less interested in what happens, this quarter, next quarter, and the quarter after. So, in that sense, removing away from a bit of the short-termism that we tend to see in global equity markets, that could actually be a positive.
Yes. Where's a lesson, though, that you've learnt of late where something of that nature, and I'm thinking something of the likes of an Oriton, comes into play where, you could say that valuation-wise the market had been ignoring it for a while. It had sort of, if anything, been unloved in terms of ownership to a degree, having started out, from the founder's perspective, very much holding it close, and then families change and all the rest of it. So it underwent that metamorphosis, and it also underwent a strategic change where it decided to go perhaps into the middle of the market rather than stay top end. So how do you value things at that point where, there's been quite a step change? So actually it was a retailer, not in Australia, but actually based over in Sweden and global. It's H&M, if you know H&M, the fast fashion retailer. Now, they're obviously majority owned or substantially owned by a Swedish family. This is an instance where I believe the family, taking too longer term view and being too slow moving, have kind of missed the online move, and now the space, as we all know, is hyper competitive. If you look at the H&M share price over the last 2 years, it's basically gone straight down. So actually we profited from this opportunity on the short side. One of our funds is a global equity long short fund, so it was in our short portfolio how we dealt with that. How and what sectors do you sort of apply that blowtorch, if we can characterise it as such? That short position, it would primarily be into which areas, if you took a broad top-down view?
Sure. On the short side, typically at the moment we're seeing a lot of businesses which are being structurally challenged by the likes of Amazon and by the likes of these new business models, whether it's a Facebook, Google. Advertising's obviously changing. I mean, we're in the News Corp building right now, so obviously yes, we know all about it here as well. So where new technology comes and really disrupts other business models. I'll give you a really quick example. I mean, take Energizer batteries, right? Simple batteries.
The bunny.
Exactly, the Energizer bunny. Well, Amazon started selling batteries at about half the price, and that's because Energizer's gross margin is 50%. So Amazon said, we'll just take that gross margin and hand it back to consumers.
Sure.
That's pretty tough competition for an Energizer.
Sure. So how do you then respond as an investor? Do you say that it's lights out? There's no va-va-voom left, or you can, I mean, that's a bit like a Woolies sort of blinking on margins, is it not? There's a new reality upon it, but it is still a mainstay, it's a household name, therefore, I can still see the value, intrinsic value, yes or no?
Well, so it comes back to what I said originally, which is then you have to say, so what's priced in today? Because I could tell you a wonderful story about a business that's going to do really well or really poorly, but if the market's already taking all of that into account today, then there's no trade on the long side or the short side. So in the case of H&M, in the case of Energizer, we believe the market's expectations have been too high for too long and continue to be that way.
Can you apply that to any kind of a view domestically? And I know your focus is primarily offshore, but you know, if you were to apply the logic here and say the market's, you know, it's been too over-optimistic for too long.
Yes.
In this regard, here or there.
Yeah. So well, look, a couple of things I would say about the Australian economy. First of all, with respect to new technologies competing with some businesses, that's absolutely real here, and with the launch of Amazon recently, that's only going to become more real. I wouldn't like to be a brick and mortar retailer based in Australia at the moment.
What about Altium and this experience with Oracle and the notion that fundies here are serially undervaluing forward projections on growth?
Well, they may or may not be, but I think what they're doing is, I think a lot of people fail to take into account the possibility of domestic businesses being taken out or acquired by their much larger global peers, and that's always a risk. And I mean, it's a positive risk for anyone who owns the stock. And you know, in many cases, it's better to be lucky than smart. And hopefully that happens to more Australian businesses.
Is it axiomatic though that it simply is the spectre of an offshore takeover that we must be bracing for, or what about bolt-ons via domestic incumbents? To their businesses to sort of build out. I mean, we saw this with Downer and Spotless. You know, on the face of it, it did not look as if the two were compatible, and even to this day, they look an unhappy couple in many ways. But the numbers are stacking up.
So I think what you've described is absolutely possible for localised businesses. For technology businesses in particular, it's very, very difficult in Australia to do it because technology businesses now and going forward are developing algorithms that tailor experiences down to the individual user based on historical data. You need tons and tons of data. And we're a tiny little island with not very many people. We don't have enough data.
Unfortunately, in its baby phase rather than its growing up stage.
Right.
All right, you've got to go to the big, cloud or whatever it is in the sky, aka the Googles of this world.
Correct.
And their spawn. Thank you so much.
Pleasure.
Happy New Year. Appreciate it.
Happy New Year.
Okay, there you have it. In Microcosm, some views via the Sydney-based Montgomery Global Investment Management's portfolio manager, Andrew Macken. We will take a break.